There's this seductive little piece of mental math in finance that I think we all just inherently trust. It's almost like a law of nature.
It's comforting, isn't it?
So comforting. It's called the rule of 72.
Ah, yes. The classic cocktail party trick.
Yeah.
The napkin math of the millionaire next door.
Exactly. For anyone who hasn't heard of it, or maybe just, forgot high school econ, the idea is simple. You take the number 72, you divide it by your expected annual return.
Right.
And that tells you, roughly, how many years it takes to double your money.
And so if you think you're getting, say, 7% a year,
then your money doubles every 10 years. It's neat, it's tidy, and it sells this beautiful dream. Just put your money in the market, go to sleep, and the compound interest magic just happens.
It feels inevitable.
Totally inevitable. It feels linear, like a staircase that just, only goes up. You just have to stand on the escalator and wait.
But that's the thing about physics, isn't it?
Yeah.
Gravity doesn't just work on the way up.
Right. And when I was digging into the data we have for today's deep dive, well, my jaw just about hit the floor. Because sometimes that staircase doesn't just stop climbing.
Sometimes it levels off.
Sometimes it turns into a completely flat line for 17 years.
That is the reality check most investors, even seasoned ones, are just not prepared for. We call those the lost decades.
I was looking at this historical data that's analyzed by the legendary investor Mohnish Pabrai. And get this, between 1965 and 1981, that is a massive chunk of time.
That's an entire career for some people.
An entire career. The Dow Jones Industrial Average started that period at around 870.
So.
And in 1981, 17 years later, it ended at around 870.
17 years. Zero index appreciation, not a penny.
Zero. Imagine retiring in 1965 thinking, okay, I'm set for life, and then you watch your portfolio do absolutely nothing for almost 2 decades, while, by the way, inflation is just eating your lunch.
It's a nightmare scenario.
So I have to ask you, listening right now, what happens to your retirement plan when the market goes nowhere for 20 years? Because today, we're going to shatter the buy and hold and ignore it myth.
We are. The whole mission for this deep dive is to move beyond that blind faith. We need to actually understand the mechanics, the literal physics of why markets boom and why they inevitably bust.
We're not just looking at lines on a chart today. We're trying to look at the machinery underneath.
Exactly.
And we have quite the stack of research to pull from. We're combining that empirical history from Mohnish Pabrai, which covers about 125 years of market data.
It's an incredible data.
With a theoretical framework that I can only describe as a sort of grand unified theory of economic cycles. This comes from an analytical heavyweight known online as Mr. Brain.
It's a really powerful combination. Pabrai gives us the undeniable historical fact of these flat lines. And Mr. Brain gives us the why, the physics, the constraints, the human inertia that drives these incredible swings.
Now, before we really jump into the mechanics of this pendulum, I have to admit something. The hardest part of all this, for me anyway, is knowing where we actually are in the cycle.
Of course. Hindsight is 20/20.
It's so easy to look back at 1981 and say, oh, that was obviously a bottom. It's much, much harder when you're in the messy middle trying to figure out if you should be greedy or if you should be fearful.
Precisely. You need some kind of thermometer. You need to know the temperature of the market to know if we're freezing or if we're overheating. Because if you don't know the temperature, you have no idea how many layers to wear.
And that actually brings us to a specific tool we wanted to highlight today, because this is a real problem for investors.
It is.
So to actually track this total market temperature yourself, you're welcome to search for and download the iOS app Buffett Indicator from the Apple App Store.
It's a very, very useful tool just to visualize the extremes we're about to discuss.
Yeah.
It basically shows you when the market's total valuation has detached from the underlying economy.
Which is usually the big warning sign, right? The sign that the pendulum is about to swing back hard.
It's the fever breaking.
Absolutely. So check that out, the Buffett Indicator app. Now, we also have to get the legal stuff out of the way because we are diving deep into financial concepts and, we want to be responsible here.
Right. So for the record, full deep value research reports can be found in the description links. All the analysis we're doing is based on publicly available sources and may be subject to revisions or differing interpretations.
And this content is for educational purposes only. It does not constitute investment advice. You have to conduct your own due diligence before making any investment decisions.
And if you want to listen to our full deep dive about this topic or access even more advanced contents, you're welcome to join a Deep Value Club membership or subscribe to us on deepvalues.ai.
Okay, disclaimer done. Let's go back to the history books. Because this idea that the market flatlining is some kind of rare glitch in the system, turns out it's actually more common than the booms.
For long stretches of time, it is the default state. Let's really unpack that 1965 to 1981 period you mentioned.
Okay.
So the Dow starts at 870, ends at 870. But here is the crucial piece of context that Pabre highlights, and this is where people get really confused. The U.S. economy didn't stop. It wasn't dead for 17 years.
That's the bizarre part. We had growth, right? I mean, we went to the moon in '69. There was a cultural revolution. People were buying cars, building houses, the whole 9 yards.
The economy grew significantly. GDP was way up. Corporate earnings were generally up. I mean, American companies were making a lot more money in 1981 than they were in 1965.
But the stock market didn't care.
The stock market did not care. And this is the first huge lesson. Economic growth does not equal stock market returns.
That feels so counterintuitive. If the companies are making more money, why isn't the stock price going up?
It's all about the starting valuation. In the mid-60s, you had the era of the Nifty 50. These were the big blue-chip stocks that were considered can't-fail investments.
The darlings of Wall Street.
Exactly. People were so optimistic, so euphoric, that they bid the prices of these stocks up to the stratosphere. They effectively paid for the next 20 years of growth up front.
So they ate their dessert before dinner.
A perfect analogy. And then they had to sit at the table for 17 years just waiting for their digestion to catch up with reality. You can have a booming economy and a totally dead stock market if the price you paid at the start was, frankly, delusional.
That is just psychological torture. I mean, imagine being an investor then. You see the news, companies are growing, your neighbor's getting a raise, but your account balance just will not budge. For years.
It would test anyone's resolve.
Yeah.
But then, the pendulum swings.
And when it swings hard. We enter the period from 1982 to 1999.
The glory days.
Oh, yeah. This is when the stocks for the long run idea really took hold.
The Dow goes from under 900 to over 12,000. That's a 15% annualized return for nearly 2 decades straight.
And that's where the stocks always go up. Myth gets cemented in our brains, right? If you started investing in the 80s, you thought you were a genius.
You thought 15% a year was just normal.
It's the baseline.
Exactly.
Yeah.
And that created a whole generation of investors with completely unrealistic expectations. It totally broke their risk radars. And that euphoria, of course, culminated in the dot-com bubble.
Where valuations didn't just detach from reality, they left the solar system.
They were measuring things in eyeballs, not earnings.
And then look what happens next in the data. From the year 2000 to 2012.
Another flat line. Another lost decade. Even with the huge crash in 2008 and the subsequent recovery, if you just look at the start and end points of the S&P 500, it was a wash for equity investors.
And Pabre points out something really, really scary about the NASDAQ during that time.
The tech index.
From 1980 to 2000, the NASDAQ was, as I said, a rocket ship, 20% growth a year. Everyone wanted tech. Then the bust hits. It drops 75%.
75%, from a peak of 5,000 down to around 1,250. Just a brutal, brutal collapse.
And here is the stat that just haunts me. It took 16 years until 2016 for the NASDAQ to just get back to where it was in the year 2000.
16 years to break even. Now think about what happened in those 16 years. This wasn't a period of technological stagnation. This was the golden age of the modern internet.
I mean, come on. This was the era where Amazon became the everything store, Apple launched the iPod, then the iPhone, and changed the world. Google became a verb. Netflix destroyed Blockbuster.
All of the FAAng stocks, the giants of today, were born or came of age in that period.
That's the aha moment right there. You could have owned some of the greatest, most innovative companies in human history, Apple, Amazon, but because the index itself was so wildly overvalued in 2000, the index as a whole went nowhere for 16 years.
Even with those massive winners, the sheer weight of the starting valuation just crushed the returns for the average investor.
It's such a sobering reminder that innovation doesn't automatically mean profit for the investor if the price you pay is wrong.
It's the whole ballgame. If you pay 100 times earnings for a company and it grows its earnings by 10% a year for a decade, the stock price might not move an inch.
Because the valuation multiple is just compressing back to sanity the whole time.
Exactly. The air is coming out of the balloon.
So that's the U.S. story, multiple lost decades. But if we really want to see what the mother of all bubbles looks like, we have to travel across the Pacific.
We have to talk about Japan.
The Nikkei index. This is the ultimate cautionary tale. If you think the U.S. market is somehow invincible, you have to look at Japan in 1989.
It's a history lesson every investor needs to learn.
So set the scene for us. It's the late 80s, early 90s. Japan is, economically speaking, taking over the world. They're buying Rockefeller Center. They're buying Hollywood studios. Japan Inc. is this unstoppable force.
The euphoria was completely off the charts. The Nikkei peaked in late 1989 at around 40,000.
Okay, 40,000. Now, fast forward 29 years to 2019. Where is it?
It's still at roughly half of that peak, about 20,000.
29 years later, and you're down 50%? That doesn't just destroy the rule of 72. That's the rule of you're broke.
It's generational wealth destruction.
Yeah.
And the symptom of that bubble, the specific detail that just blows the mind, is the real estate statistic that Pabrai always mentions.
Oh, this is my favorite insane fact in all of finance. So, in 1990, the grounds of the Imperial Palace in Tokyo,
Just the palace grounds, not the whole city.
just the land the palace sits on, was valued higher than all the real estate in the entire state of California.
Let that sink in for a moment.
I'm trying. California, we're talking thousands of miles of pristine coastline. We're talking the entire agricultural heartland of America, Silicon Valley, San Francisco, Los Angeles, Hollywood, the Redwoods, all of it.
Beverly Hills, Malibu, Napa Valley.
All of that was worth less than one single palace in Tokyo.
It sounds physically impossible. Pabrai himself said he found it so incredulous he had to go back and check the math himself. But it was true. That is what happens when a property bubble completely seeps into the equity markets.
It's not just irrational. It's a complete distortion of reality. It's mass hysteria expressed in currency.
And the hangover from a party that big.
Lasts for decades.
Yeah, exactly. The bigger the party, the greater the hangover. And there's a cultural nuance there too, which Pabrai points out is really important.
In Japan.
Yes. Japanese companies culturally are just different. They often hoard cash. They prioritize their employees and their societal stability far above shareholder returns.
So they become these classic value traps.
Precisamente. You look at the balance sheet and say, wow, this company is trading for less than the cash it has in the bank. This is a bargain.
But if they never give you the cash, if they never do a buyback or issue a dividend,
It's an illusion. The value is locked away in a vault you can't access. It's like a museum exhibit of wealth. You can look at it, but you can never, ever touch it.
and it's not just Japan. Let's take a quick hop over to South Korea, the Kospi Index.
Another fascinating case study. From 1989 to 2019, that's a 30-year span.
Okay, 30 years.
The index went from 1,000 to 2,000.
So it doubled in 30 years. That's terrible. What is that, like 2% a year?
Barely over 2% annualized return. You're probably losing money after inflation.
And again, think about the narrative. This was the era of the miracle on the Han River. Samsung became a global dominant force in electronics. Hyundai cars are everywhere now. The entire Korean GDP just exploded.
Massive economic growth. A true modern success story.
But the passive investor who just bought the index, they got almost nothing for 30 years of patience.
It's the same lesson over and over again. The economy is not the stock market.
So we've established beyond a doubt that linear growth is a lie. Markets overshoot and they stagnate for very long periods. But why? Why can't they just track the GDP nicely and go up a few percent a year?
This is where we need to bring in the theoretical part of our deep dive. We need to introduce Mr. Brain and his framework, the physics of the cycle.
This is where it gets really interesting for me, moving from the what to the why.
This is where we get to the core mechanics. Mr. Brain uses a very simple, very elegant model from physics, the pendulum.
Okay, so let's visualize a pendulum, like a grandfather clock or a swing set at a park.
A pendulum's movement is governed by two fundamental opposing forces. First, you have constraint. We can think of this as gravity.
Okay, gravity.
Gravity is always pulling the pendulum back toward the center, toward its point of equilibrium.
Right. And in market terms, that equilibrium is what? Fair value.
Exactly. It's the price that accurately reflects the underlying fundamentals. But then you have the second force, inertia or velocity.
The speed.
Yes. When the pendulum reaches that center point, does it just stop dead?
No, of course not. It's moving way too fast. It swings right past the center and all the way up the other side.
Precisely. And in markets, these forces translate perfectly. Constraint is reality. It's limited resources, limited credit, limited demand. There is only so much oil in the ground. There are only so many people who can afford to buy a new iPhone this year. That's gravity.
And the inertia, where does that come from?
That's us. That's human psychology. It's the belief that it will keep going up forever. It's greed. It's fear of missing out, but also structural. It's things like corporate investment lag.
Explain that lag. How does that create inertia?
Well, think about a big mining company. They see copper prices are high. They decide to open a new mine. But that's a huge undertaking. By the time they raise the capital, get the permits, do the engineering, and actually dig the hole, it might be 5, 6, 7 years later.
And by then, the cycle might have already turned.
The price of copper might be in the gutter. But they have the momentum, the inertia of this massive project. So they finish the mine anyway, adding a huge amount of new supply to an already falling market, which makes the crash even worse.
So they overshoot because the corporate brakes don't work instantly.
They barely work at all. It's like trying to turn an aircraft carrier. Mr. Brain quotes that ancient Chinese historian Sima Qian, right?
Yeah, I love this quote.
No wealth through force, scant wealth through intellect, great wealth through timing.
That is the essence of it, isn't it? You can be the smartest person in the room, you can work harder than anyone else, but if you fight the pendulum, If your timing is wrong and you fight the cycle, you lose.
You lose every time. And this process creates a loop, doesn't it? A self-reinforcing loop.
Reflexivity. George Soros built his entire career on this idea.
Absolutely. A positive feedback loop works like this. The economy is doing okay. People feel optimistic, so they go out and borrow and spend. That extra spending makes the economy better.
Which in turn makes people more optimistic.
So they borrow and spend even more. Prices go up, asset values go up, everyone feels rich. It just feeds on itself. It overshoots to the upside.
Until it hits a wall.
Until the constraint hits, maybe inflation spikes and the central bank has to raise rates. Maybe we run out of skilled labor, something breaks. Then the loop reverses.
Negative feedback.
Constraints hit, people have to pull back their spending. Pessimism sets in, so they start hoarding cash instead of spending it, which makes the economy even worse, which makes pessimism even deeper. It overshoots to the downside.
So markets are never actually at equilibrium. They are just passing through it at high speed on their way to the next extreme.
Mr. Brain calls it a second-order differential equation, or a damped oscillation. It's a system that naturally oscillates. It cannot stay still. Its default state is to swing.
Okay, so we know it swings. It's a pendulum. But are all swings the same? Because, sometimes we have a little recession that lasts a year, and sometimes we have the Great Depression. The swings seem to have different sizes.
This is where the framework gets really interesting and really practical. Mr. Brain categorizes the cycles into 4 distinct clocks of the economy. They're all ticking at the same time, but at very different speeds.
Okay, let's break these down one by one. Clock number 1, the kitchen cycle.
This is the shortest one. It runs for roughly 3 to 4 years. This is the inventory cycle.
How does this one work? I always think of this as the bullwhip effect they taught us about in business school.
That's exactly what it is. It's a brilliant name for it. Imagine you run a retail store. You sell widgets. Sales start picking up by, say, 5%. You think, great, things are looking up. I need more widgets on the shelves. I don't want to run out.
So you overcompensate a little. You order 10% more just to be safe.
Right. And your wholesaler sees this 10% jump and orders from you and all the other stores. They get excited. They order 15% more from the factory.
And the factory sees a 15% jump and thinks a boom is here. They hire a whole second shift of workers. Everyone is hiring. The economy feels great.
But then sales at your store slow down just a tiny bit. Or maybe you just realize you ordered way too much. Suddenly your warehouse is full to the ceiling with widgets you can't sell.
So you stop ordering completely.
You stop ordering. Your wholesaler is stuck with a warehouse full of widgets. They cancel their orders from the factory. The factory has to lay off that entire second shift. Those laid-off workers stop spending money at your store.
And boom, just like that, you have a mini recession.
Exactly. The constraint here is simple. Warehouse costs and working capital. You can't hold inventory forever. It takes about 3 to 4 years for the system to clear all that excess and start the cycle all over again.
Okay, that makes sense. That's the short-term noise. What's clock number 2? The juggler cycle.
This one is a bit longer, 7 to 11 years. This is the CapEx or machinery cycle.
CapEx being capital expenditures, so big investments. Why 7 to 11 years? What's special about that time frame?
Think about big physical equipment. A factory machine, a fleet of semi-trucks, a building full of server racks. They don't last forever. They wear out, or more importantly, they become obsolete. And that happens roughly every decade.
So companies have to replace them all at once.
They tend to, yes. It happens in waves. During a boom, every company invests in new factories and new technology.
Right.
That creates jobs, it creates overcapacity. Then for the next 5 or 6 years, they stop investing. They just wait for the machines to wear out and depreciate off the books.
And that pause in investment is what causes those mid-size recessions we see every decade or so.
That's a major driver of them, yes.
Got it. Okay, clock number 3, the Kuznets cycle.
Now we're zooming out even further, 15 to 25 years. This is the real estate and construction cycle.
And this one is tied to people, right? Demographics.
Yes, biology is destiny here. This cycle is highly correlated with new household formation. When a big generation like the baby boomers or the millennials reaches the age where they move out of their parents' house, get married, and want to buy their first home, you get a massive, sustained wave of demand.
But buildings last a very long time.
A very long time. You build a house that stands for 50, maybe 100 years. You don't need to rebuild it every year. So supply comes in these very slow, very massive ways.
And when you overbuild...
When we overbuild housing like we did in the U.S. leading up to 2008, it takes a very long time, 15 years or more, to absorb all that excess supply. That's why real estate crashes are so deep and so painful.
And finally, the big one. The grandfather clock of the economy. The Kondrativ wave.
The K wave. This is the long one, 50 to 60 years. This is the innovation cycle. It's driven by fundamental, world-changing technological revolutions.
Like the steam engine.
Exactly. The first wave was steam and textiles. Then came the age of steel and railways. Then electricity and chemicals. Then automobiles and petrochemicals. And most recently, the wave we've been riding is information technology.
And how does this 50-year cycle work?
A new technology emerges, and it creates massive growth. It completely changes how we live and work. We spend decades building out the new infrastructure, laying the railway tracks, stringing the electrical wires, building the internet backbone.
But eventually it hits a limit.
It hits market saturation. Everyone has a car. Everyone has a smartphone. The explosive growth phase is over. The economy then tends to stagnate or even enter a depression until the next major technological breakthrough happens and the next wave begins.
So we have these 4 clocks all ticking at once: inventory, machinery, real estate, and innovation.
And this is where Mr. Brain brings in the nest and doll theory, which I think is a brilliant way to visualize it.
Like those Russian Matryoshka dolls.
Exactly. These aren't 4 separate tracks running in parallel. They are nested inside each other, influencing each other.
So what's at the very center? The smallest doll.
At the very center is pure, raw human emotion. Greed and fear. Even if resources were infinite and technology never changed, our own psychology would still create volatility. We play what Keynes called the beauty contest. We don't buy what we think is valuable. We buy what we think other people will think is valuable.
So that's the rapid day-to-day noise of the market.
Right. Then wrapped around that emotional core is the next doll: explicit financial constraints. This is the world of credit cycles, debt limits, and inflation.
So this is where governments and central banks come in.
Yes. Governments loosen credit to stimulate the economy and fight a recession. But eventually, they hit the constraint of too much debt or runaway inflation. Then they're forced to tighten policy, which causes the next recession. It's its own cycle.
And the outer doll, the
Yeah.
biggest one.
Those are the fundamental constraints, things that are even bigger than finance. Political terms. The 4-year election cycle in the U.S. incentivizes short-term boosting of the economy regardless of long-term consequences. And physical limits. How fast can we actually extract lithium from the ground? How many more transistors can we really fit on a microchip?
So Mr. Brain talks about super resonance. That sounds cool, but what does it actually mean in this context?
It's when the cycles align, when the different clocks all chime at the same time. The biggest, most euphoric booms and the deepest, most painful busts happen when these different cycles synchronize and reinforce each other.
Can you give us a real-world example?
Absolutely. Look at the period from, say, 2009 to 2021. Think about what happened. First, the financial cycle. After the 2008 crisis, we had a decade of massive quantitative easing. 0% interest rates, basically free money everywhere.
Okay, so the credit cycle was on full blast.
Full blast. Second, the contractive wave. We were in the steepest part of the mobile internet explosion. Smartphones, the App Store, cloud computing, it was changing everything.
And third,
The CapEx and inventory cycle. Everyone on Earth had to go out and buy a smartphone. Companies had to build massive data centers. Telcos had to lay fiber optic cables.
so you had free money meeting a revolutionary technology that required a massive build-out of new infrastructure.
It was a super resonance, a perfect storm for a massive bull market.
But now, I mean, everyone has a phone.
And money isn't free anymore. The resonance is gone. The cycles are desyncing.
Which leads us to a really important discussion, because I hear people say this all the time, especially when the market gets choppy. They say, oh, I'm just going to buy safe stocks. You know, the classic advice.
The cycle-proof sectors.
Exactly. People always need to eat, so I'll buy consumer goods. Or tech is the future. It doesn't cycle, so I'll just buy tech.
Mr. Brain calls this the myth of cycle-proof sectors. It's a dangerous fallacy.
Let's bust the consumer goods myth first. Why isn't toothpaste and soap a safe bet forever?
It's the fallacy of confusing a need with growth. Just because people need it doesn't mean the stock will go up indefinitely. Consumption is constrained by 3 very powerful forces. First, income. It's the wealth effect. When your house value drops by 20% and your stock portfolio drops by 30%, you feel poorer. And when you feel poorer, you change your behavior. You buy the generic brand of toothpaste, or you try to stretch that tube for another week.
What's the second constraint?
Debt. It's simple math. If you're paying off a massive mortgage and huge student loans, you have less discretionary income left over to buy new things.
And the third. This seems like the big one.
Demographics. This is the slow-moving killer for consumption growth. Older people consume less. It's just a fact. They already have their house, they have their furniture, they have their car. They aren't buying new stuff at the same rate. As populations age, which is happening across Europe, Japan, China, and even the U.S. overall consumption growth naturally has to slow down.
So consumer goods are definitely not cycle-proof. They have their own powerful constraints. But what about tech? The argument you always hear is tech is different. Tech is exponential. It doesn't cycle. It just zooms upward.
Tech is exponential for a time, but it always runs into diffusion limits.
Fusion limits. What does that mean?
Think about the classic S-curve of technology adoption. From roughly 2010 to 2020, mobile internet went from, say, 10% adoption among the global population to nearly 100% in the developed world.
Yeah.
That steep part of the S-curve is where you get explosive high growth.
But now
Everyone who wants a phone has a phone. You can't go to 110% adoption. You've hit the diffusion limit. Growth has to slow down.
Mr. Brain mentioned 5G in the source material. That was supposed to be the next big thing, the next growth driver.
But what new use cases did it really bring for the average person? It just made your TikTok videos load a fraction of a second faster. It wasn't the paradigm shift. So we find ourselves in a stagnant period technologically, waiting for the next big paradigm. Maybe it's AI, maybe it's something else.
And until then, tech becomes cyclical.
Deeply cyclical. We see it most clearly in semiconductors.
Oh yeah, the chip cycle is brutal.
The semiconductor cycle is the juggler capex cycle on steroids. When there's a shortage of chips, prices spike. So every company announces they're going to build new billion-dollar chip plants. But by the time those plants are actually built 3 years later, there's a massive glut of chips. Prices crash. It's clockwork.
So nothing is truly safe. Everything cycles. This is starting to sound a little bit depressing. Is the answer just to put all your money under the mattress and wait for the apocalypse?
No, absolutely not. Volatility isn't just risk, it's opportunity. The answer isn't to hide from the wave. The answer is to learn to surf.
Surfing the wave. I like that.
And Mr. Brain offers a very specific, very practical strategy for handling what he calls strong cyclical stocks. Things like commodities, raw materials, shipping, energy. He uses lithium as the case study, and it's a masterclass in cycle timing.
Okay, so challenge accepted. Let's get practical. How do we actually make money from these cycles without getting crushed? Mr. Brain outlines what he calls the 3 waves of a bull market. Let's walk through them step by step.
All right. Stage 1 is called the capacity clearing. My favorite name for it is the invisible turn.
Invisible because on the surface, everything still looks terrible. The price is still going down.
Exactly. The scenario is bleak. Product prices are at multi-year lows. Companies in the sector are going bankrupt. The media is full of headlines saying the lithium dream is dead.
And this was literally the situation for lithium in 2019, 2020, right?
It was. The price had already dropped from highs of over $150K a ton down to $40,000 or $50,000, and it just kept crashing. Australian mines are closing down. All capital expenditure, all plans for new mines were canceled.
So everyone is fleeing the burning building.
But this is where the signal is. You have to ignore the price. You have to ignore the headlines. You look for the supply-demand inflection.
Break that down. What does that mean in practice?
You have to become a detective. You look at the hard data. On the supply side, you see that supply is being actively destroyed. Mines are closing. That's a very bullish long-term signal. But what about demand?
That's the other side of the equation.
At the exact same time, EV sales were actually starting to accelerate. Tesla was ramping up production in China. European emissions regulations were kicking in, forcing car makers to go electric.
So you have supply destruction meeting demand creation?
Precisely. Even if the news is terrible, even if the price is still dropping, the underlying physics make a sharp turn inevitable. The rubber band is stretched too far in one direction. That is when you buy.
That sounds absolutely terrifying, though. Buying when everyone you know is telling you it's over.
It feels like trying to catch a falling knife.
Yeah.
But it's actually the point of maximum financial safety because all the bad news is already priced in. There's no one left to sell. Then, and only then, comes stage 2.
Which is volume and price rise. This is the sweet spot.
This is when the turn becomes visible to everyone. The product price, lithium in this case, actually starts ticking up. Sales volume explodes as the EV boom takes off, and corporate profits just soar. But here you run into the valuation trap.
Okay, what's the trap in the sweet spot?
It's the PE ratio, the price to earnings multiple. As earnings are skyrocketing, the PE ratio actually drops rapidly. So the stock looks cheaper on paper, even though the price has already gone up a lot.
So new investors look at it and they say, wow, this company has incredible growth and a low PE. This is a bargain. I'm all in.
And this is the easiest money. The wind is at your back. The trend is your friend. But you cannot get complacent, because that complacency leads you directly into the jaws of stage 3.
The performance release, or as I like to call it, the danger zone.
A perfect name for it. The scenario now is the complete opposite of stage 1. Prices are at all-time highs. The PE ratios look incredibly low, maybe 5x or 6x earnings. The media is screaming, super cycle. Lithium is the new gold.
So why is this so dangerous? It sounds perfect. Low valuation, high growth, great story.
Because the supply response has finally arrived. Remember the inertia. All those new mines that companies started planning back in stage 2, they are now finally opening.
The floodgates are about to open.
The floodgates open. And if you see the product price stall or even dip slightly at the exact moment that massive new capacity is coming online, the cycle is over.
Even if the PE is 5, that feels so cheap.
Especially if the PE is 5. That low PE is a giant trap. It means the market knows that earnings are at a peak they can never, ever sustain. The E is about to collapse.
So what's the action?
The action here is simple and brutal. Sell. Ignore the low valuation. Ignore the great story. Don't look back.
And Mr. Brain has a fantastic quote about regret minimization here. He says something like, if you made 30x your money from stage 1 to stage 3, don't risk it all trying to squeeze out the last 10%.
That is the discipline. Pigs get fat, but hogs get slaughtered. It's always better to leave the party a little bit early than to be the one stuck cleaning up the mess at 3 a.m.
This brings us to the final section of our deep dive. And honestly, this is the part of Mr. Brain's analysis that stuck with me the most. Because he pivots. He stops talking about stocks and commodities and starts talking about life.
The philosophy of the trough.
Right. He argues that these same cycle dynamics apply to social class, to family wealth, to careers, not just to stock tickers. And he has this definition of what class or wealth really is that. Well, it's profound.
He says that true wealth isn't defined by how high your peak is. Your peak can be luck. It could be leverage. It could be just being in the right place at the right time during a boom.
Anyone can get lucky.
True wealth, he argues, is defined by how high your trough is. When the cycle inevitably turns against you, how far do you fall? What is your bottom?
It's about resilience, not just peak performance.
Exactly. And he compares 2 famous Chinese real estate tycoons to illustrate this. Xu Jian of the company Evergrande and Pan Shi of Soho, China.
Xu Jian was the poster child for the peak, right?
The absolute poster child. At his peak, he was the richest man in China. He had private jets, championship football teams, immense political clout. He leveraged everything to the absolute maximum. He was always chasing the peak.
And his trough. What was his bottom?
Prison. His assets were seized. He's a complete zero. The cycle turned, the real estate market crashed, and he had no floor underneath him. He fell all the way to the bottom.
Now, contrast that with Pan Shi.
Pan Shi saw the clouds gathering on the horizon. He started selling off his prime real estate assets in 2014, way before the crash. He was criticized for it. People probably called him foolish for selling too early and missing the final leg of the boom.
What is trough?
He's living comfortably abroad with his family. He preserved his wealth. More importantly, he preserved his freedom. His personal bottom was higher than 99.9% of people's peaks.
There's a reference in the material to the classic Chinese novel Dream of the Red Chamber. The line is white snow on clean earth.
It's the idea that the higher the peak, the more spectacular and devastating the crash if you haven't managed the downside. The goal of investing, and really the goal of a well-lived life, isn't just to maximize the highs. It's to consistently raise the floor of your lows.
So that every time the pendulum swings back, and we know it will swing back, you land on a higher platform than you did during the last crash.
Exactly. That is real progress. That is true compounding. Compounding isn't just about the percentage return. It's about never interrupting the chain with a zero.
Okay, let's try to tie all of this together. We've covered a massive amount of ground today.
We have. Let's synthesize the key takeaways. 1, linearity is a lie. The market is not a staircase. It's a pendulum. It overshoots and it stagnates.
2, history is a warning. 17-year flatlines are not an anomaly. They are a feature of the system. Don't assume the index will always save you.
3, physics is real. You cannot argue with the forces of supply and demand, constraints, and inertia. They will win in the end.
4, the clocks are always ticking. You have to know which cycle you are playing. Are you in a short-term inventory correction or at the end of a 50-year technological revolution? The strategy is completely different.
And 5, watch the trough. Build a portfolio and a life that is robust enough to survive the bust, not just one that maximizes the boom.
And practically speaking, what this means is don't be a passive victim of the pendulum. Learn to read the signs. Look for the turning points. Buy when supply is being destroyed, not when the hype is at its peak.
And use the tools available to you to gauge the temperature.
Right. And seriously, check out that Buffett Indicator app on the iOS App Store. It's a great, simple way to just get a reality check on where the pendulum is sitting right now. Are we near a point of rational equilibrium, or are we swinging wildly out to an emotional edge?
Knowing that answer changes your entire perspective.
And of course, for those who want to really geek out with us on this stuff, check out the community at deepvalues.ai and the Deep Value Club. That's where we get into the nitty-gritty details.
Indeed.
I want to leave everyone with a final thought. We've talked a lot today about mechanics and physics and cycles. It can feel very deterministic, like we're all just cogs in a giant, uncontrollable machine.
It's easy to feel that way.
Yeah.
But we aren't just cogs, we are the operators of our own little machines.
Exactly. And we often feel like we are the masters of our fate. But if the greatest, most powerful economies in human history, the US, Japan, all the rising powers are subject to the laws of financial gravity, then so are we. The question isn't, will the winter come? The winter always comes. The cycle always turns.
The only question that matters is, how warm is your coat when it does?
That's it for this deep dive. Thanks for listening, and we'll catch you on the next swing of the pendulum.
Stay warm, everyone.